Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash-flowing properties in today's market. Here's your host, Gabe Peterson.
All right. We are back with another episode of the Real Estate Investing Club. I hope you guys are having a great day wherever you are out there, whenever you're listening to this. It is a Friday, as always, here on the podcast. We're bringing that Friday energy to you. And, I know I've said this for every single episode for the past, 2 months, but I love fall. It is so nice. It's nice and crispy here today in Seattle. I got my cup of coffee, so I'm enjoying it. But it's a good reason. It's a good day for a second reason, because we have Michael Parks with us on the show. Mike, I didn't even ask how to pronounce your name. Do you like Michael or Mike?
I go by Michael, but neither one offends me. So
okay, we're going with Michael then. Michael is a multifamily syndicator as well as a hard money lender. So we're going to go into both of those strategies on this episode. Both good businesses to run if you're in real estate. So Michael, thanks for hopping on the show.
Thanks for having me, Gabe. I really appreciate it.
Absolutely. I told you before we got on here, we always like starting with stories to hear how people got to where they are. I'm sure you got a good story. So take us to the beginning of your story in real estate and tell us how you got here.
Yeah, so I worked for some publicly traded REITs, real estate investment trusts. We had 30 billion in assets under management. And 30 billion, right? So I was like, I've always had an interest in real estate. I've done some vacation rentals, some things smaller. And then when my eyes were open to, hey, there is a business of running real estate investing. It really changed my perspective from continuing to buy my own rental properties to how do I pivot this into a business, and how do you look at a small portfolio that you might have in a $30 billion company and say, how do I go from A to B? Like, that's a big jump, right? So I educated myself. I learned about multifamily syndications and syndications in general, and said this is the answer. This is the way to start, right? It's very similar to what we do in the big REITs. It's just minus a few zeros. So that's how I got started. Is getting into multifamily syndication, and basically, still working to hit that $30 billion mark, but we're considerably smaller.
One of these days. The REITs, they're a whole different ball game there. So when you have those big funds, you're throwing around multiple zeros at these properties. So starting small is how I like it. I like small teams. I don't really want to grow to be 30 billion. But so tell us about your first foray into it. You came from a REIT background, which is, I'm sure it's a very interesting perspective to have, because their underwriting is generally on the longer side. They're looking at properties. How is this going to be in 10 years? How's it going to be in 15, 20 years? When you're looking at smaller guys, we tend to have a shorter time frame, like the 5-year-ish mark. How are we going to get out of this relatively quickly? So when you had the REIT perspective and you jumped into your own business, how did that transition go, and what were some things that kind of surprised you?
Yeah, I mean, one thing, and you hit it spot on. The REITs, at least the ones I was involved in, were very long-term plays. It was a buy and hold strategy, and risk reduction, and because of that, investors only expected fairly low returns, right? They felt that those stabilized assets were very safe. And those returns, to me, they're not great. And so when I learned about...
Let me ask real quick, what are, if somebody invests in a REIT, what is the return that the REIT is, projecting for them?
Yeah, I mean, the ones I was involved with, and it varies year to year, 4 to 6%.
Really? Wow, that is low.
Yeah.
4 to 6%. That is, that's crazy.
Well, and you got to think these REITs, publicly traded REITs, people are investing in them like stocks. So they're like a bond alternative, a diversification play. It's looked at very differently than those of us in this business look at real estate. We look at it for really good returns, like you get stock market level returns, but asset-backed securities with real estate behind them, direct ownership. depreciation. Like we all know those things. The investors that are investing in REITs, they're just clicking buttons on their Fidelity account saying, yeah, I want to buy some real estate and take some out of my bonds and that sort of stuff.
Huh.
And there are REITs that are more aggressive, but I mean, I'm talking about the ones I'm familiar with.
Yeah, makes sense. And sorry, I jumped into your response there. So, yeah, how did the transition go when you got into when you started your own syndication?
Yeah, I mean, it went well, right? It took a while. You don't just go in and say I'm starting. You go in and say, what do I need to learn? So it was a lot of education. I'd say a good solid year of education and networking before I did any kind of a syndication with other people's money. And when I did do that,
when you did that, so education, networking, great way to start. Obviously, were you doing it systematically? Were there certain positions, certain contacts that you wanted to make, and how did you go about building that for yourself?
Yeah, I found mentors, informal mentors. I never did do the pay a mentor type of thing for this. So yeah, I found mentors that were willing to help, that showed me the way, and continued to network with other people who had success, who have done this for years. And I think my REIT background, I understood the business, so there was a lot I knew. But there was a lot I didn't. So it was about finding those finding those right mentors, being able to run things by them, feel confident in what we were doing. And then when we did our first syndication, I did it as a partnership. I didn't do it on my own. And that's the way many people do it, because you want to partner with people with more experience, diversified skill sets. To do something that is somewhat complex and larger and maybe out of state, like, you need a team. So building that team of both partners as well as professionals, real estate brokers, mortgage lenders, et cetera, right? That was important. And that took a while to figure that out.
Yep, absolutely. So let's go to that first one. Let's really dive into that first deal. How'd you find it? What was the team that you built? What positions did you have in place when you went to the closing table? And then what did the deal look like?
Yeah, so the first deal, one of my partners found it. So we had been in communication for the better part of 7 or 8 months in a mastermind group, helping each other out in terms of underwriting deals, finding deals, all that sort of stuff. And he found it next to his house. It was literally like 2 blocks away. And it was in Tennessee. It was a 34 unit. And he had been actually chasing this deal for over a couple of years, kind of made friends with the on-site maintenance person, and had contacted the owner several times. And finally, the owner was some children of the original owner who had passed, and they said, it's time for us to just move on. And he had built that relationship, so we got it under contract pretty quickly, and then we said, hey, you know what? We need a little bit more expertise than the two of us, and so we brought in 2 people that ran a property management company in the area and had also been doing syndications for several years. He was local. My partner was local, but that found the deal. But also these guys were local, so we had a really good local team, built-in property management. It was a value-add property, and I couldn't have asked for a better team to go execute that. They really, had the chops, knew what they were doing, had the connections, had the relationships with all the contractors. It was pretty turnkey, which was phenomenal.
Nice, I love it. So you had a team of 4 to do this first real syndication.
Yeah, the main team of 4. We had a couple other people that we had relationships with that we brought in as well on some more minor roles. Yeah.
Yeah,
and then we did, we did it. You said, what's the roles? Like we laid it out, who's doing what, pretty clearly, and we changed it a little bit as we went. I played a much bigger role in financial analysis, underwriting, not just the original underwriting, but managing the financials ongoing. That became really an expertise that I took on in a much bigger way, raised some capital. The original plan was for me to do a little more investor relations, but somebody else picked that up in a bigger way as I dove more into the financial side.
Yeah, and I feel like it's important to call that out, that, you guys, there were 4 of you, and you kind of built the team as you got into the deal. You realized that you had some gaps that needed to be filled. because it works so much better when you find people that you align with, both in terms of which role they're going to take, and then also the values. Values is so important. You guys have to align with values in your partnership. If you don't, that's when things go sour. And so, I've had a lot of people on the show that don't like partnerships. I'm a super big fan of them. I think they work great. It makes the deal more fun. We do this not just for money. We do it also to feel like we're giving back to the community, and to have connections with the people that we're working with. And so you really do have to have your values aligned, and you have to really understand who's going to be doing what at the outset, because that really it aligns intentions, it aligns under expectations, so you guys can really stay in your lanes and execute well. So I love how you did that. I like that you guys, you built it out systematically. You filled the roles that needed to be filled, and then you weren't inflexible as things kind of progressed, and you realized some people are better at this role, some people are better at this other role. You allowed it to change and evolve over time. So that's great. Have you guys exited that deal?
We haven't. We were on the verge of what would have been a perfect BRRRR, right? The buy, rehab, rent, refinance, repeat. And then the interest rate market went like this, right?
Yep.
So we were just probably 4 months a little too late, where the interest rates were creeping up. And we have a great interest rate. It's 3% for 8 years. Like, seller finance. So
why would you refinance?
it was like, we're returning 12% on people's money in distributions right now, and when we do sell, it will double everybody's investment. So it's a great property, and now that we see interest rates maybe starting to come back down, I think potential exit next spring. But we'll just watch the market and see. Right now, it's just making money.
Nice, I love it. So this is a shorter form podcast. I really want to dive more into your multifamily, but I know you have the second business you started into hard money lending. I feel like that is a great business to second business to start if you're in real estate. If you're already out there, you understand what you're doing, you understand how to underwrite multifamily or single family or self-storage, whatever it is you do. It's great to start a lending business on that same asset, because you understand the business, you understand how it works, and you can call out when an operator has a deal in their hand. So tell us about starting that lending business. How did it go? How did you get it set up, and why did you choose to start it?
Yeah, and I started this with my partner Jeremy Lemire. The two of us run the Navigator Wealth Fund, and he is known for large self-storage in the Greater Green Bay area, and done a ton of single family, and together we've done a ton of multifamily. So all three that you mentioned is really where our core expertise is. And the reason we got into it is we just saw the opportunity in the market. So two things. One is the interest rates have gone up. Bank liquidity has gone down. Lending criteria is tougher at banks now than it was, before the interest rate climb. The issues that happened with various banks getting in trouble on their liquidity. The whole market tightened up on lending. And so that creates a great opportunity for those people who are finding deals and finding great deals and be able to make money, but they need to lend, or they need to borrow, I should say. And so there's an opportunity to lend at rates that are fairly comparable to a lot of equity deals, and in a far less risk position, right? The loans are always paid before the equity. Now, you don't have potential huge upside, but 10%, 12% on your money in a very low risk position in the capital stack, we think it's really great risk adjusted returns. That's where we're putting our money. So that, and that's where our investors with us want to put their money alongside of us. And, we'll see how long that market goes, but right now that is a great place for risk adjusted returns, we think.
Nice. So are you guys doing bridge lending, or are you doing long-term lending on these deals?
Bridge and hard money, very short term, 6 month, like for fix and flip, is mainly where we're focused. But we've done some bigger bridge loans as well.
That's for the commercial side, for self storage you mentioned.
Yeah, we did it for a large multifamily development project, a hotel conversion, and so we're focused more around the 1 to 4 unit fix and flip. But when we see a good deal, we'll lend on it. So what self-storage, as you probably know, is a little harder to borrow against than multifamily. There's just, less, they don't have agency debt and stuff, so forth. So there's opportunity in self-storage lending for sure that we'll tap into. But right now, the fix and flip market's where we're focused.
Yeah, I've always thought that I haven't done it myself. I feel like I should put my money where my mouth is, but I feel like in self-storage and then mobile home RV parks, those are the two assets that I focus on. And getting a loan for those two asset classes, oh my God, it is hard. We just bought a mobile home park down in San Antonio. It's a slam dunk deal. That's just it. Like I know it's a great deal. I've done these deals before and it's great. I knew it, the underwriting was there's no way to look at it and feel like you're going to be losing your money here. And yet we could not get a freaking lender to jump on it. And I just feel like there's a huge opportunity out there to help investors who want to focus on these lesser known asset classes to do lending and to help investors get these under contract, get them closed, and obviously get a payday for both the lender and the investor. That's just my side note there.
Yeah, mobile home parks are like self-storage in that way. We haven't done mobile home parks, but certainly it's ripe for lending for all the reasons you said.
Yep. So was there anything, I guess this is speaking from my own ignorance. I've never, lent out my money. Was there anything that kind of surprised you about starting a hard money business?
It's harder than you would think.
Okay.
So it seems pretty easy, right? You take your money, you lend it, you take back a mortgage, and you collect your payments, and so be it. The people who are coming to you typically are doing some kind of a lot of times coming to you with construction, right? And so managing your construction draws, your inspections for that, right? And this is a little different game. I mean, if it was a mobile home park, maybe it's a little simpler because there's not a lot going on. But if you're doing a fix and flip, one, you got to inspect the property up front to make sure that when the borrower says the after rehab value is $500,000, that it's really $500,000. How do you get comfortable with that, right? And so we've got a great partnership that does value opinions for us. Also pre-reno, post-reno, different levels of reno. It's really a value add to the borrower as well. To help them understand how much to renovate a property. That gives us a lot of confidence that we've got a good ARV that we can trust when we go in and lend against it. And then as they're doing construction draws, it's easy to, when they call, oh yeah, this is all done. Great. Send me, $20,000. Okay. How do you make sure that that's done? And how do you make sure that they didn't miss some really big things code wise, right? So things like that. So inspections are an important piece of the puzzle to put together.
That is interesting. That is not something that I would have thought initially. When I think of lending from being someone who has not done it before, I really just feel like it's paper. It's just you're signing paper. You're doing maybe an initial inspection, but you're right. Construction draws, doing setting up a process to get the property inspected as money is being withdrawn. That would be a deal. That would be something that you actually have to deal with. So makes a lot of sense. All right. Well, I just took a peek at the clock. It looks like we have run it down. So it's time to jump into the quick question round. Are you ready?
Let's do it.
All right. Starts with books or any form of education. I always say books, but it's not only books. If you got a conference that you like, if you got a movie that you really were attached to or anything, I just need 2 recommendations, one for general life wisdom and then one for real estate.
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com. So if you are interested, head on over there. With that said, let's get back to the podcast.
General Life Wisdom, it's an old book. I don't even know how many people know of it anymore. 7 Habits of Highly Effective People.
That was my first like kind of self-help genre of books that I read. I love it. It's that's Stephen Covey. That was one of the best, I feel like.
Yep, it endures time. It's worth a reread if you haven't read it in a while. Every one of those 7 habits, if you practice them, make a difference in your success. So, on the business side, I think maybe I'm like everybody. I'm enamored with Chris Voss's "Never Split the Difference." I'm in awe of what he can do, and I try to practice it. But man, it takes more than reading the book to be an expert, but it has helped, and so I love that one.
I have not read Never Split the Difference. I actually haven't. It's on my shelf. And so many people have suggested it, but I've never read it. Just give us like the quick synopsis of what it's about.
So if you look at like Covey, you find a win-win. With Chris Voss, his negotiation tactic is, I'm going to win.
All right.
and this idea of meeting in the middle, finding common ground and overlap and putting a deal together where everybody's in their space. He just has a different tact to it that comes from hostage negotiation that he previously did in his life. And it's just a whole different way to think about it and come out with a much better outcome for you as the negotiator.
Yeah, obviously in real estate, we are in negotiations all the time. And as I get further and further in my career and I rack up the number of negotiations I've done, I start to think that it's actually, you come out with a more accurate value, or more accurate end result if both parties are very aggressively negotiating for their own interests. Because if you try to split the difference, then more often than not, you're going to be kind of on the side of the person who is not splitting the difference. And so I kind of think of it as like two magnets, and the more you pull, they pull apart. It's, there's still the center that they're, that's not a good example. Scrap that one. But it's just, I feel like you always get a better result for both parties if you're both negotiating for your own interests. And so it makes a lot of sense to me. I know it sounds kind of I don't know, not very, I don't know what the word is, but just not very kind, I guess. But it makes a lot of sense in the actual application of negotiating. Is just very aggressively negotiating for your own interests. If both parties do that, then the end result is most likely more fair than trying to split the difference with them.
Yep.
And I like that you said 7 habits. You're actually the first person to say that on the show, and it is one of my favorite self-help books. So good call out.
Right.
All right, next question is for your younger self. Let's go back to the Michael who was just getting started at the REIT so many years ago. Go back to him, look him in the eye, give him one piece of advice moving forward.
Take more risk early. So I'm going to go back like all the way to when I was a younger person. My gray hair would show my age. So if I go back to my younger self, when you're young is the time to take more risk. You have less to lose. It gets harder as you go, right? You start building, you have a house, you have cars, you have a wife, you have kids, you have expenses, you have people relying on you. Much harder to take bigger risks. When you're 22, 25, 30, whatever your stage in life before you have all of that, that's the time to take it.
That is good advice, especially for your younger self, is take risks. Next question is about the US. It's a big place. There's a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
Love Overland Park, Kansas.
Interesting. Okay.
Kansas City in general, Overland Park specifically. I actually have a deal there, and number 2 rental market in the country. It has not blown up with rents going through the roof. And prices going through the roof the way that you've seen in some of the southern states that are now kind of contracting. But it's been steady growth, population growth, steady, wage growth, steady rent growth, and you can do well there long term.
Nice. Yeah, I've heard good things about KC. Good metro and just solid growth. It is frustrating that they don't allow you to look at comps for single family, but yeah, great market for sure. All right, next question is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. So what's your favorite way to generate leads and find new deals?
So I'm going to turn this one a little bit from finding an asset to buy and finding a loan to lend on, right? So that's where I'm focused now, is in that hard money lending business. And that is all about like marketing and relationships with potential borrowers. So believe it or not, borrower needs to find you, or you need to find them in order to lend, right? It's not always pretty obvious. So we brought in a partner that has been originating loans in this hard money space, in this market for at least 7 or 8 years. So he's got a tremendous network, and that's how we're getting our deal flow. We get dozens of deals a week through that process.
Nice. Networking for sure. Great way to find lenders and to find deals. Which brings us to the next question. This is about lessons learned. Not every deal we get into goes the way we expect it. In fact, most of the time something goes wrong and we get to learn a lesson. So what was the deal that went a little sideways for you, and what was the lesson you pulled from it?
So we involved with a deal that's the hotel conversion. Hotel conversions seem easy on the surface. They're particularly challenging in execution. I think everybody's who's doing them has found that out. Big lesson learned. Number one, boots on the ground is a must. Number two, contractors that fit the scope of the job. So if you're doing a small 4-family house, that's likely not the same contractor that's doing a 150 unit hotel conversion. So you got to get contractors that are sophisticated enough that they fit the job that you have for them.
Yeah, and I found that's also true for property managers. Property managers are specific to a size of unit, which isn't like super intuitive, but it is just how it plays out. Is that a property manager that manages a 100-unit complex is not going to be a good one to hire for somebody that does 1 to 2 units, and so that's a really good call out, and something that it's not intuitive and it's not apparent when you first get into it. All right, that leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a 2-parter. Where can they find you? And then what can they expect when they reach out?
Yeah, great. So you can find me on our site, navwf.com. So that stands for Navigator Wealth Fund, but navwf.com. You can book a call with me there. You can email me, michael@navwf.com. Glad to set up a call. I talk with a lot of real estate investors that either want to invest alongside of me or just want to find out more about what I'm doing. And I am glad to share all of those things with anybody. My journey, some details. I do a lot of informal mentorship with people. I don't do paid mentorship, but I'm glad to help pay it forward and help people move their goals in their career along.
Perfect. I'll put that link in the show notes. So if you guys want to reach out to Michael, just click the little more in the description. It'll pull down that full description in there. You can find his link. All right, man. That wraps it up. Thank you very much for hopping on the show.
Thanks. I appreciate it very much, Gabe.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at therealestateinvestingclub.com. If you guys want to support the show, just give us a like or subscribe or whatever it is on the device you're listening on. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.
All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.